Okay, let's unpack this. We are diving into CSX Corporation today, a real titan of American infrastructure. I mean, this company owns something like a 20,000 route mile rail network. It's this fortress, really, built on steel and land, almost impossible to replicate. Makes it a vital artery for the eastern U.S. economy.
Yeah, absolutely vital. But here's where it gets really interesting, is that huge, impossible to copy dominance actually enough to guarantee success right now? Our analysis shows the stock's trading at a premium to what we think its intrinsic value is. So the core decision you face is, well, does that super high quality justify paying, frankly, full price, especially when they're dealing with some major headwinds?
Right, headwinds like what exactly?
Oh, you've got a brand new CEO, revenue that's basically stalled for 2 years, and then there are the dampening effects of these new 2025 tariffs on, global trade volumes. It's a tricky mix.
That sets up our mission for today, then. This deep dive is based on a comprehensive report focused on CSX, that's ticker CSX, with a closing price of $35.30 as of October 29th, 2025. We're going to cover the business model, the new leadership situation, the financials, how the market sees it, and the critical risks. Everything you need to understand what really drives this Eastern Railroad giant. Okay, let's start with Chapter 1, Business Analysis, the engine of the Eastern economy. We begin with the engine room itself. CSX is a Class I freight railroad. What that means, fundamentally, is really stable revenue, mostly from long-term transport contracts. And their business breaks down into three key areas. It shows you exactly where the money comes from.
Right, that segmentation is important for understanding the diversity, or lack thereof sometimes. The biggest chunk is merchandise. That's the most diverse, covers everything: chemicals, cars, construction materials. Huge strength there, that diversity. Then you've got coal. Historically massive for them, obviously, but it's very subject to swings in the global energy market, environmental policy changes, that sort of thing.
And the third piece, the one often talked about as the growth engine, is intermodal.
Yeah, intermodal. This is moving those standard shipping containers, seamlessly between trains, trucks, and ships. It's the fastest growing bit because it offers that rail cost effectiveness and environmental benefit for the long haul. But you still get the truck flexibility for the final mile. The value proposition is pretty stark. One train can haul the load of, several hundred trucks?
It's a huge efficiency gain.
Massive. But the real story of CSX, maybe more than what they move, is that moat, the barrier to entry. You mentioned the 20,000 miles of track.
Yeah.
Just think about the cost.
Yeah.
Building that today, you're talking hundreds of billions of dollars. It's a classic oligopoly, heavily protected.
And it's not just about laying track, is it? There's regulation, contracts. You mentioned paper barriers earlier. What exactly does that mean for potential competition?
It's a really crucial point that locks in their advantage. So, okay, beyond the crazy capital cost and the dense web of FRA regulations, railroads have these historical contractual things, often called paper barriers. These are legal agreements, sometimes decades old, that literally prevent a new company from easily accessing key lines or interchanging traffic. It just restricts competition and basically forces customers to stick with the incumbent, like CSX here. Wow. So if you're a big factory or plant already served by CSX rail lines, the cost and hassle, regulatory, physical, of trying to switch to someone else, even if they existed, would be astronomical.
Exactly. That translates directly into massive economies of scale for CSX and really high switching costs for their customers. It's a powerful combination.
And just a quick reminder for everyone listening, please like and subscribe to the Stock Analytics AI YouTube channel. Your support helps us keep doing these deep dives.
All right, let's shift gears from the network itself to the people in charge. We're moving into Chapter 2, Management Evaluation, new captain at the helm. And there was a pretty big, maybe abrupt leadership change late in 2025, wasn't there? Oh yeah, major shift. Steve Angel took over as president and CEO in September 2025. He's a very accomplished executive, no doubt, but, and this is significant, he's an outsider to the rail industry. He previously ran Linder, industrial gas giant, did incredibly well there, generated a, 219% shareholder return. And right around the same time, the CFO also left. So big changes at the top.
An outsider. The market's seen this before at CSX, right? It kind of echoes 2017 when they brought in Hunter Harrison specifically to implement this big operational overhaul. PSR, they called it.
Precision Scheduled Railroading, yeah.
For listeners who aren't railroad buffs, what exactly is PSR?
Fundamentally, PSR is about running the railroad much more like a tight, efficient factory assembly line. You prioritize efficiency and using your assets, trains, tracks, crews constantly. It generally means running fewer, but longer, trains on a very fixed, precise schedule. You don't wait around for a train to be completely full. It cuts costs, offer dramatically, but it needs really disciplined management. So bringing in Angel, an outsider known for operational rigor, suggests the board is signaling another big push for that kind of metrics-driven improvement.
Okay, so the focus seems to be on efficiency and returns. And looking at their capital allocation, that seems to bear out. They've got, what, 21 consecutive years of dividend increases?
That's right. An 8% hike just in February 2025. The quarterly dividend is now $0.13, and they are very aggressive with share buybacks, too. Repurchased over $1.1 billion worth in just the first 6 months of 2025.
Impressive shareholder returns, but we need to balance that. Let's do an efficiency check. You mentioned return on invested capital, ROIC. How's that looking?
Well, that's where the story gets a bit darker. The trailing 12-month ROIC is currently 9.19%. Now, that sounds okay maybe in isolation, but it's a significant drop from the peak back in 2017, which was 19.27%. So they're now generating considerably less profit for every dollar they invest back into the business.
Wait, hold on. That's like a 10 percentage point drop in efficiency since 2017. That's huge. If their operational output is degrading like that, even with this apparent new mandate for efficiency, why is the market still giving them such a premium valuation? What are we missing?
That is the puzzle, isn't it?
Right.
And maybe part of the answer, or at least a complicating factor, is this. Well, this ethical contradiction that seems to be emerging. CSX heavily promotes its One CSX culture, safety, teamwork. They have a formal code of ethics. But federal court findings show a really troubling pattern. A federal judge, just in October 2024, ordered CSX to pay over $453,000 because they illegally fired 2 employees who reported safety concerns way back in 2017.
And you're saying this isn't just a one-off HR dispute?
Doesn't look like it. That ruling follows similar findings of retaliation against safety whistleblowers in 2021, 2020, and 2016. One of the most serious involved firing someone who reported illegal drug use by colleagues who were operating heavy machinery. It suggests, frankly, a systemic gap between the company's stated values on safety and ethics and maybe the reality of its internal culture. That's a governance risk.
Okay, let's move on then to Chapter 3, Financial Analysis. Under the hood of the balance sheet, the underlying stability of the business, that moat, is solid, but these recent headwinds, they have to be showing up in the numbers, right?
Oh, absolutely. You see, a revenue growth basically stalled for 2 full years now. It declined 3.8% on a trailing 12-month basis, down to $14.12 billion. That's mostly because of kind of a double whammy. Lower global coal prices hitting that segment, and also less revenue coming in from fuel surcharges as fuel prices may be moderated a bit. Now, their profitability is still elite compared to many industries, but the TTM operating margin is compressed a little, down to 34.9%. Still very high, but lower than it was.
And free cash flow, FCF, that's always a critical one for investors. How's that looking?
FCF saw a pretty notable decline. It was down 16.8% in 2024, landing at $2.78 billion. Now, this isn't necessarily a sign of fundamental weakness in demand. It seemed to be a direct result of increased capital investment back into the network. They spent $1.7 billion of their 2023 CapEx budget just on essential infrastructure tracks, bridges, the basics. That necessary reinvestment eats up cash that would otherwise be free for shareholders, you see.
Makes sense. And the debt.
Debt seems manageable given those reliable, almost utility-like cash flows. Their debt-to-equity ratio is 1.6 here. That's a bit higher than their main rival, Norfolk Southern, which is around 1.15, but likely manageable. And yeah, the current ratio is low at 0.77. Technically a red flag if you just look at the number, but it's pretty typical for these capital-intensive railroads that manage their working capital very tightly.
Okay, let's tie this back to valuation, which you flagged right at the start. We're looking at a trailing 12-month price-to-earnings ratio, PE, of 23.0. How does that stack up historically?
It's definitely a premium. Historically, CSX usually trades closer to an 18 PE. Even competitors, like Union Pacific, are currently around 18.4. So that 23 PE tells you the market is placing a big bet. They're betting heavily on the new CEO, anticipating a pretty rapid and significant turnaround in efficiency and maybe growth eventually. Those expectations are baked into the current price.
Right. And to try and ground that market speculation, we also look at intrinsic valuation, usually using a discounted cash flow or DCF model. The idea here for listeners is to try and ignore the day-to-day market noise and estimate the company's true underlying worth by projecting its future free cash flows and then discounting them back to today's value based on risk and growth assumptions. We'll circle back to those DCF results in our conclusion.
Okay, moving into the second half, let's look at Chapter 4. Market sentiment. How is Wall Street actually processing this mix? The stability, but the high valuation, the operational questions. It seems complex. It really does. And the analyst's perception, highlights this kind of fascinating paradox. If you just
Yeah.
read the headlines, the consensus rating for CSX is a strong buy. Sounds
Yeah.
great, right?
Yeah, sounds very bullish.
But then you dig into their actual price targets. The average 12-month price target is only $39 per share. Now compare that to the current price of $35.30. That implies only about 10% upside potential.
Huh. So the analysts are basically shouting, buy, but whispering, but don't expect it to go up much.
That's kind of the vibe, yeah. The insight seems to be that they view CSX not as some deeply undervalued growth stock that's going to rip higher, but more as a high-quality, stable, almost safe harbor stock. You know, reliable, defensive holding in a portfolio, even if you have to pay a full price for that safety and stability right now.
That perception of safety seems reinforced by some of the technical data.
It does. Look at short interest, the number of people betting against this stock. It's incredibly low, only 1.5% of the available shares, the float. That's way below the average for its peers. It shows a really strong consensus that there's very limited downside risk seen in the stock. And technically, the price action is positive too. It's trading above both its 50-day and 200-day moving averages, indicating positive momentum in the short and long term.
Okay, let's move on to Chapter 5. Ownership structure. Who's on board? A quick look here usually tells you something about stability.
That's right. And no surprise here, it's heavy institutional dominance. Somewhere between 77% and 80% of the shares are held by the passive giants, Vanguard, BlackRock, State Street, those usual suspects. This creates an extremely stable shareholder base, which is pretty typical for these core S&P 500 infrastructure-type companies. Stable, but maybe not very active in terms of governance.
Right, passive money. But the really potent signal here seems to be the insider activity, which ties right back to the new CEO we discussed.
This is the big one. This is the real skin in the game moment, as they say. Direct insider ownership across the board is generally tiny, negligible almost. Except the new CEO, Stephen F. Angel, he made a really substantial open market purchase, bought 55,000 shares for over $2 million back on October 20th, 2025. Putting that kind of personal money on the line right after taking the job, that's a massive tangible vote of confidence in the company's future under his leadership. You can't really ignore that.
Definitely a strong signal. Okay, before we wrap things up, let's consolidate the potential downsides in Chapter 6. Risk assessment, potential bumps in the track ahead.
Okay, risks. Internally, that governance risk around the whistleblower lawsuits hasn't gone away. It creates, direct financial liability from potential litigation, but also that slower erosion of reputation and maybe internal morale related to safety culture.
Yeah.
That's a concern. We also can't just brush past the $164 million goodwill impairment charge they took. That was related to their Quality Carriers trucking segment underperforming. Shows not everything they touch turns to gold.
And then externally, the macro picture looks pretty challenging.
Yeah, the broader economy is throwing up some major roadblocks. You've got persistent inflation, maybe running 2.5% to 3.0%, and high interest rates. That tends to dampen demand for big-ticket items, cars, houses, which are key components of CSX's high-margin merchandise business. Less stuff being bought means less stuff to ship.
Although, there's a flip side to high energy costs, isn't there?
There is, yeah. The silver lining, if you can call it that, is that high fuel costs make trucking much more expensive relative to rail.
Yeah.
That actually amplifies rail's cost advantage, especially for their intermodal segment. So it cuts both ways. But the most specific, maybe the biggest external threat right now, is the impact of the new 2025 tariffs. Economic models are projecting these broad-based trade tariffs could reduce long-run U.S. GDP by maybe 0.4% and potentially crush exports by as much as 15%.
Wow, 15% on exports. That directly shrinks the total amount of goods flowing through the economy that are available for CSX to transport, right? Especially hitting things like cars and steel.
Exactly. It shrinks the pie. This is a very real, measurable headwind that's likely going to impact their revenue volumes, probably for the next few quarters at least.
Okay, it's time to bring it all together. Let's synthesize this into the Chapter 7. Conclusion. Looking at the bull versus the bear case.
Right, the bull case. It's pretty straightforward and really powerful. CSX has that unbreachable competitive moat, the network, the scale. You just can't replicate it. They have a history of consistent, stable financial performance, a fantastic track record of dividend growth, and now you've got this renewed executive confidence, strongly signaled by the new CEO buying $2 million worth of stock. Plus, that long-term secular shift of freight from trucks to rail, especially intermodal, that remains a huge underlying tailwind.
Okay, clear bull case. Now the bear case.
The bear case focuses much more on the near-term turbulence. The company is facing significant macro headwinds right now, those tariffs, high interest rates, and they are stalling revenue growth. We see that in the numbers. The stock is already trading at that premium PE of 23.0, well above its historical average. And that governance risk, the shadow cast by the history of retaliating against safety whistleblowers, that remains an elevated concern.
And bringing in that DCF analysis we mentioned earlier, what did the models suggest for intrinsic value?
Okay, so our educational DCF models, which try to estimate that underlying worth based purely on future cash generation potential, they place the fair intrinsic value range somewhere between $33 and $34.50.
Okay, $33 to $34 to $34.50 compared to the current market price of $35.30.
Exactly. So it suggests the market price is slightly above, or maybe at the very top end of, that estimated intrinsic value range. There's a premium being paid currently.
So the concluding outlook really crystallizes that trade-off, doesn't it? It seems you're paying a full, maybe slightly premium price, but you're getting an exceptionally high-quality, stable business that's incredibly difficult to disrupt. It looks like a safe, probably reliable long-term holding, but maybe not significantly undervalued at this specific moment.
Which leaves you, the listener, with an important question to mull over, I think. Given those quite strong safety culture concerns, evidenced by multiple federal court rulings, is the cost of that ethical risk, the fines, the potential hit to morale, the ongoing litigation risk, is that something that permanently lowers the stock's intrinsic value? Or is that something the new CEO, precisely because he's an outsider, can successfully tackle and engineer away? That's a key judgment call you have to make.
A very interesting point to consider. We've covered a lot today, from the incredible power of that rail network to the very real risks from tariffs and governance questions. Thank you for taking this deep dive with us into CSX.
And remember, please like and subscribe to the Stock Analytics AI YouTube channel. For just €4.99 a month, you get full access to our playlist of over 500 deep dive videos covering all the S&P 500 stocks. And coming up next, exclusively for our members, we're tackling the NASDAQ 100. Plus, members can request specific stock deep dives. Just drop the ticker symbol in the comments on any video and we'll get it on our list for you.
And finally, the important reminder. This analysis was generated by an AI system and is intended for educational purposes only. It should definitely not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.